Hey, this is Hutch with bankingtruths.com, and today I'm going to address one of the biggest misconceptions that people have when starting a whole life policy for infinite banking or retirement that actually puts their family at risk. And the notion I'm talking about goes something like this. I want this policy for cash value growth primarily. I don't care about the death benefit. So if I can keep the fees and the costs down, I'll put the policy on my younger spouse or even my kids, because then I'll get the best performing policy. And that's really what I care about. And this seems to make sense in a vacuum, but the part of the equation that people are missing is it's not only the cost per unit of insurance for the insured, but it's how many units of insurance or the volume of insurance is necessary to fit the kind of premiums in there that you want to fit. And younger kids or spouses need a lot more death benefit than, say, a male breadwinner who's a little bit older than his wife and a lot older than his kid. In the past, looking at this with whole life is very tough because whole life is a black box. It's a bundled product. But with our new AI analytical tools, we can really unpack this myth by showing you a case study where we look at both cash value and the volume of death benefit that cash value is supporting to see whose policy really works better. All right, so I'm first going to show an example of a dad versus a daughter, and later I'm going to show an example of dad versus mom. And this particular example is showing $50,000 in premium. I realize that may be a lot for some people. That's okay. If you can only do 5, just divide this by 10. We're looking at ratios, and probably you can't even get $50,000 of premium into a kid policy unless your net worth is really, really high. But again, just to compare apples to apples, we equalize the premium for all 20 years. The dotted line just shows the cumulative premium, $1 million going in. And what you can see down here, everything is exactly the same. However, if I drag base over here and just compare base premium of dad to base premium of daughter, you can see dad's base premium is higher. And so therefore, you would think, and you'd be right, that his costs are more by about $1,100 of those $50,000 premiums. And that means that dad can put in less PUAs versus term versus the daughter. Now, the daughter gets $1,100 more PUAs. So you would think on paper, in a vacuum, daughter's policy is going to be crushing dad's. Well, let's see what actually happens. So if I move from the premiums tab to the cash value tab, you can see here just isolating cash value between blue and pink, dad and daughter, that dad starts to actually pull ahead, which kind of doesn't make sense because we saw that dad had more base premium, less PUAs, but it's because if I move to the death benefit tab, daughter has to hold so much more death benefit, and that's what that hollow bar is above the shaded part. The shaded part is the cash value, right? That's the cash value. That's the death benefit. I'm going to shade the cash value. Daughter needs so much more death benefit around the same or similar amount of cash, the premiums you put in order for it to be taxed favorably by the IRS, like life insurance, that even though her cost per unit is lower, her actuarial cost structure actually works out to be more. And we can go back to the cash value tab. In fact, we can go down to this table here and see that in the difference column between dad's cash value, daughter's cash value, daughter's ahead by 1.4 thousand, 2.7 thousand, 1.3 thousand. Dad's ahead by $900, and we're talking on almost a couple $100,000. So you can see, in spite of dad's early costs being higher, he actually starts catching up, and that's because he needs so much less death benefit. Daughter's ahead by a few hundred as cash value goes from $250,000 to $500,000, and then dad is ahead by just about 1,000, then 16,000, 41,000. And granted, we did jump to 5-year increments, year 10, 15, 20, 25 down here, but this is some real cheddar. As a percentage of the cash value, it's not that much, 99,000 on 2.8 million, 71,000 off 2.2 million, but it is actual net spendable dollars that dad could have used for retirement if he would have gotten the policy on himself rather than his daughter. And again, I know this is kind of confusing. And if I just go back up here to look at the annual return, not IRR, which is like you just pick a point in time and you measure what a steady return would be. Annual return is just the year-over-year growth. So we know the first year's negative, the second year's negative for both of them. Now dad's ahead 0.8 versus -8. And again, that's just what the cash value was last year, whatever premium came in and what it grew to. The first years are the worst years, then it starts getting pretty good, right? And dad actually starts to pull ahead in all these years. So even though he starts back, he pulls ahead almost like a horse race. And this is all nominal, meaning just like the actual year over year return. If we do the tax equivalent, well, this is why you go behind, or why you would do whole life and be behind for a couple years, so you can take these huge strides forward. It's basically the numbers you're looking at are what you'd need to earn in a savings account, pay a 30% tax. That's what I programmed in here to have it equal what the cash value is growing to year over year. And I realize this is complicated and it's not linear. And as much as we want simple and linear in a world of complexity, if you're doing infinite banking or thinking of doing infinite banking, what I can tell you is if you go with simple, oftentimes the devil will be in the details. We've seen it 1,000 times where people get policies because they just found somebody who they liked and made it simple for them. But then there was let's just say not that great of math kind of lurking in the details that they didn't explore. And that's why we made these AI tools, so that we can have all the analytics right at our fingertips, and we can go as deep as we need to go while explaining the complexity and then showing them it's not just our opinion, it's not just our story, but proving it with the math behind it. So that way you actually get the custom fitting, the measurements that you deserve for what you're trying to accomplish with this. All right, so now we're going to move on to an example of dad and mom. If I jump to the premiums tab, both age 37, dad's the same icy blue, mom is this bright yellow here. You can see the same $50,000 premiums for 20 years. They both end up with $1 million. Having paid $1 million of premium. If I scroll down to the difference and we just drag, nope, I don't want to make it upside down, drag the base over there, you can see the difference between dad's cash value, premium and mom's base premium. Dad's paying a little bit more base, couple $100, not much, and therefore mom is paying that much more in PWAs. There's $1 difference because of rounding. But if we jump to cash value and look at that cash value curve, it's really hard to see who's ahead and who's not. They're almost neck and neck. When we get out here, you can see mom's returns are starting to be a little better, 0.1%. And if you look at the tooltip over there, that little or the little bar with the table, mom's ahead by about 10 grand. I've locked in the cash value difference here, and we can see year by year, mom's ahead by a couple few hundred, a couple few thousand. At the end of 20 years, she's up by 5,000. And then we go into 5-year increments, and she starts to pull ahead by 5 figures, all the way up to 6 figures at life expectancy. And this is where people would make the mistake and say, you know what, let's just go with the policy on mom. More is more, so let's just do that. And that's fine if mom's the breadwinner. However, if dad's the breadwinner, because females the same age as males are set to live 6 to 7 years longer than males the same age, what's more important, mom's cash value at year 50 or dad's death benefit? If you remember, dad had almost, like the base premium was almost the same. And it's because mom is set to live longer that therefore the insurance company for about the same amount of premium would give her more death benefit. But since dad's death benefit is going to come in sooner, it's more valuable because you're more likely to get it sooner. They have to charge you a little bit more. And so if we just jump to the final years, I'll just put 50 to 54 here. These guys are 37. So this gets them out to like late 80s, early 90s. And remember, the space is the death benefit. So you can see mom's cash value is ahead of dad's, but not by much. But dad's death benefit is clearly ahead. If we go all the way out to year 54, that is age 91. Again, mom's cash value is more, and it's considerably more. If we look up at that, what we call the tooltip, just the table there, mom has 9.76 million of cash. Dad has just under 9.6. So like that's a number that's like $160,000, $170,000. However, dad's death benefit, so where you want to focus is, here's mom's cash value at age 91. Here's dad's death benefit. Would mom rather have her cash value, 9.76 million, or would she rather have an extra, call it 900,000 in dad's death benefit? Probably dad's death benefit. And you could just see that visually here. She'd rather have this than this. Obviously, if it was just a cash value race, she'd rather have hers. But because we're not just dealing with the savings component, and especially way out into life expectancy, I say this all the time, it doesn't matter what you like best about whole life, you get all the benefits. And most people say they don't care about the death benefit, but I got news for you. At 91, the cash value pales in comparison to the death benefit. And if you want the highest rate of return, always, the death benefit will always be more than the cash value, just like you're seeing here. And now let's take a look at what happens when we take an older dad, age 47-year-old dad in the darker royal blue versus the same age 37-year-old mom. And if you remember, females are set to outlive their male counterparts the same age by 6 to 7 years. Now, if we add an extra 10-year differential, what are we going to see in terms of cash value? Premiums are equalized. These are the same $50,000 premiums getting to $1 million cumulative. If we look at the base right here for dad, he's paying about $1,200 more than mom. Mom has almost a true 1090, meaning a $50,000 premium and only $5,157 as base. Dad's with the $6,300 base is about a $1,387. If we go to the cash value for the 44 years that gets dad to 91, you can see annual returns are pretty close, but mom's ahead most of the time. And by a decent amount, a 0.25%, 20 basis points of a percent. And we can see that dad's annual cash value return does kind of peter out. Now, we do find this happens with all whole life policies when you get close to life expectancy. And that's because the whole life company knows that it's about to be backfilled by the death benefit. But again, the cash value isn't as important as the death benefit. And so we can see that mom has more death benefit the entire time. But when we get out to these final years, just like we saw when they were the same age, would mom rather have her cash value or dad's death benefit? And it gets very close in dad's age 91. Mom's cash value is 6.06. Dad's cash value is 549, but dad's death benefit is 610, which is more than mom's 6.06. And if we scroll down here just to look at what I did is I just picked some years around retirement, year 22, age 69, age 79, age 89, and even all the way out to age 95. This column, this pure death benefit, like dad's total death benefit is 2.834 million. Which is made up of his cash value, which is 1.8, and this pure death benefit of $1 million. So if I jump back up here to the chart and I just go 22 to 40, actually, where did I go to 48? And I just get rid of mom for a second. That space, it's not as much cash value as he has, but that's still $1 million. And people do say they don't care about the death benefit, but this is like having a rich uncle where there's like $1 million set aside for you. And now you can spend down some of your other assets, be it a 401k, you could sell a rental property, whatever that looks like. And the net death benefit, or what we call the pure death benefit, does shrink over time, but it's still a number. When we get to age 89, there's still $650,000 of death benefit over and above the cash value you can use. And so you could plot this out by looking at how much extra or pure death benefit am I going to have by life expectancy. Now I can just straight up more aggressively spend all of that extra money in retirement. And that's something most people, I find, don't think about when they're talking about infinite banking, is the value of this death benefit. And it's a number throughout, $1 million of pure death benefit. By age 79, there's 884,000. People don't always die on time. Sometimes they die early. At 89, which is about life expectancy, 650. And even if we go all the way out here to 95, which is really beyond his life expectancy, we're talking $550,000. And so that is an actual number that you can count on and more aggressively monetize through your other assets. And that's a benefit that people don't give enough credit to when analyzing an infant banking policy. It's all about the cash value. But if you get both, if you get strong cash value and you get all this extra death benefit, that is a huge win. So to clarify, I'm not saying that you shouldn't get a policy on your wife. I'm not saying you shouldn't get a policy on your kids. It's more of a when question than an if question. So just like a chess master has the same pieces and the same board layout as the journeyman or the rookie on the other side of the table, what makes him a master is the orchestration, the sequence and timings of how he deploys those pieces. And the same can be said about how you deploy your family cash flow through infinite banking. And what we find is most agents, most infinite banking agents are really just kind of recommending whatever they think the client will say yes to. So if the client's already leaning towards, I want policy on my wife, I want a policy on my kids, they just want to make a sale versus we are running in an inordinate amount of data to show how to become the cash flow chess master in this situation. And one option that I find that people don't know about is families can get convertible terms. So for instance, if dad's older, you could get a convertible term policy on mom that is like renting the insurance with the option to buy and bill, where she can lock in her rating so that even if something happens to her health, she gets to lock in the rating that she originally got for the term. And her carrying cost for that term is going to be a lot cheaper than dad's, whose pricing is already more expensive. And every year he gets older, it gets exponentially more inefficient. Versus mom, if you wait a few years on her, it's not going to be that much different. Same can be said for kids. The only thing I would add is there is no convertible term for kids. However, when we're running kid policies, we can do 1090s, sometimes 991s on kids, meaning the base policy is very small. And so you could theoretically just start the base for the kids, lock in their insurability, get a flexible PUA rider, and then stack that cash flow on whoever the biggest breadwinner is in the family and whoever's, call it insurability or performance of the underlying whole life policy is going to get less efficient the longer you wait to start it. Anyway, I hope this helps. If you're looking for your own custom analysis, go to bankingtruths.com/schedule for a live appointment with an expert. If you just want to see some data and see that we know what we're talking about, you can request an x-ray at bankingtruths.com/x-ray. And if you're an advisor and you want access to these tools, they'll soon be going live and you can sign up on the waitlist at bankingtruths.com/AIAI. And who knows, by the time you're watching this video, it may already be available. Hope this helps. We'll talk to you soon.